are in listen-only mode.
Welcome, good evening everyone. This is Admiral Markets. My name is Chris, and you're joining here the webinar on Mastering the Waves of Forex Part 2 on this 13th of August 2015. Thanks for joining. Before we take a look at the waves, be aware though that this webinar is intended for a global audience, but may not be suitable for everyone. To find out if it is and other conditions and details, please visit admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Also, please realize that trading foreign exchange and other financial markets and products is considered high risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, once again, this is hosted by Admiral Markets, and there are a lot of good things going on with Admiral Markets. Take a look, for instance, at the MT4 Supreme Edition with 50 plus extra features, such as, for instance, an alarm manager or alarm function that helps you, remind you of certain conditions that you can decide, and the alarm goes off, and you know that it's maybe time to look at the charts. So that's very useful. One of the many things that is very good about this Supreme Edition. And you can find more info just going to the website, click on Find Out More. You can see all the advantages. All right, so last week we had part 1, and you can find the part 1, by the way, on Admiral Markets YouTube channel, and you can replay that or visit it the first time. And basically, we have a 2-part series. So the goal, understanding the basics, how to manage the learning process, how to become better. It's something we primarily discussed last week already. And realizing that this is just the start. If you really find it interesting, then deeper study is good. For more wave analysis, if you want to stay in touch with the waves and you want to, for instance, see how your wave analysis matches up with my thoughts, for instance, you can do that, all right, by going to, that's the wrong link, but actually it's admiralmarkets.com/analysis, all right, you'll find daily wave analysis, but also weekly wave analysis if you write an email to info@admiralmarkets.com, and then the email will be sent to your inbox. All right, let's take a look at the agenda. Introduction, wave psychology, wave step-by-step, wave patterns, wave rules, wave guidelines. That's all we discussed last week. It was quite a busy agenda, I think. This week, we're going to take a look at wave tools, wave analysis, trying to trade the waves on entries and exits. Oh, and I think there's something missing. Oh, okay. Well, anyhow, that's already a lot of stuff. We're going to take a look at a lot of deeper kind of thinking and try to go a bit more past the, let's say, the basics of a week ago. So we're going to talk about wave tools, first of all. I talked about the rules. I talked about some guidelines. I talked about why, the wave analysis is happening, right? And all these things. But how do you take it? How do you really apply it when you look at the chart? So tools are very useful when actually doing the wave analysis because they give us a better idea if, what is our wave analysis and whether it's correct or not. So the tools are a good supportive, let's say, crutch on getting our view right and hopefully also capitalizing on that with good trades. One thing is analysis, the other thing is trading. In general, I think that waves are better analytical tool is better for analysis than maybe for trading. The tools change that because the tools make things more practical. Waves on their own are more of a general indication of how to understand the market and what you could expect about the direction and the trend. But trading it can sometimes be tricky. And tools help bridge that and make the trading a bit more accessible. So let's talk about some practical examples without the tools as yet, only adding Fibonacci. when looking at rules, guidelines, and Fibonacci's of last week, let's discuss a bit this particular action, right? When you see, for instance, a momentum to the upside like this, you see strong upside, strong bars that are engulfing those few bullish candles. What is strong momentum? Of course, that's, you can use many definitions, but if a few candles like that engulf a lot of candles like this, then typically that's strong. So this is a good upside momentum, all right? Now this, let's just forget multiple time frame analysis. Let's forget long-term counts or counts before that. Let's just focus on what this first part could be. And just looking at the momentum, we could probably already estimate it's a wave 1 or probably a wave A, because there's a lot of momentum typically, and it's the start of that, right? This is the start point. Why? Because we were in a downtrend before that, right? So when you have a start point like that, when you have a momentum and it is a starting point, it's going to be a wave 1 or A, right? So we have that information in our minds at that point. And when we then see this pullback, right, we know that that could be a wave 2 or a wave B, right, with an invalidation level right here. The bottom is an invalidation level for both counts, because an ABC zigzag would have the same as a 1, 2, 3, 4, 5, right? Now, which one of the two is more likely depends on higher time frames, depends on when looking at a larger part. In this case, we cannot estimate that. Just looking at this piece, both seem equally likely. And it doesn't really matter, because both indicate the potential for a wave 3 and C. Both indicate the potential for the third leg to be bullish. So it really practically doesn't matter. So how do we know that the upside actually turns out to be a wave C? Because when price stops at the minus 272 target, right, it's a very shallow target. It didn't go far. That's one way of using a tool like Fibonacci to estimate that this third wave is a C wave. The third wave is supposed to be far, supposed to be big, it's supposed to be momentum. And if it stops at the minus 272 like that, it's probably going to be a wave C. All right. Now, from that point of view, all right, this could still be a wave 1 and 2, and we can still get maybe a wave 3 later. That will be an alternative. That's called an extension. So those things are still possible. And you can see that later on we do get a follow through still to a higher target, to minus 618 and a minus 1000. But you can use basically fibs to estimate, what leg or what wave is it? What wave are we in, just by seeing what target we reach? Right? This is one of the conclusions you can make. All right. So when we take that picture here in the right upper corner of the 1 hour chart, and we add multiple time frames. Multiple time frames is very useful when analyzing waves, because we get to detect the story of various charts, and then we can piece together what is more likely. All right. When looking at the 4 hour chart, all right, we see that price. No, sorry, it's the other way around. Actually, excuse me. This is the 4 hour chart. Apologies. And now we're looking at the 1 hour chart. It's the other way around. We're drilling down to lower time frames. And basically what happened here is this 4 hour upside is this part. All right. And when we look at fibs, you can see, and we add price action and candles, you can see that it gives confluence here, a candlestick, bullish candlestick right at the 61.8, indicating that this could be the end of that wave B or 2 that we just discussed. That's another confluence, is another tool of estimating where price action and candles could respect the fib levels that we have in mind based on momentum and correction and the wave count. All right. We then see a bearish candle, right, at the minus 272 target. Yet again, an indication that price is probably not going to extend a lot further, right? One more clue that price is going to make a pause there. How do we know that price continues? Well, we can use, again, candlesticks, reactions at the fib confluence. right? We see a 61.8 fib here and a 38.2 fib. What kind of fibs are those? Well, if we're estimating that this is a three wave like this, there are two scenarios, I said, or three scenarios, in fact. But one of them is that this is an ABC has finished a bigger wave W. And in this case, this could be a wave X, right? In that case, it's good to fib the entire ABC. That is the orange fib. The orange fib is fibbing from bottom here all the way to top. And the price stopped at the 38.2 fib. The other scenario could be, as I said, a wave 1, 2 within a wave 3. That's why I have, actually, that is the orange fib, sorry. The green fib is actually from top to bottom. Okay. So both fibs are useful, both having a different levels, but there are some confluence levels, right, between 38 and 61, and that's exactly where price stopped. Now, do we know that beforehand? No. We have an idea? Yes. Does price action help with identifying the bounce spot? Yes. We can see that a bullish candle here is indeed, or a few bullish candles indicating the turning spot at that fib. So we'll talk about entries later on. First of all, I just want to walk through the process of the waves and how tools can help. And we're going to add more and more tools as we go along. Okay, now we're talking about fibs, price action, and candles. Soon we'll be adding escalator, fractals, and moving averages, and you'll get a very, very wide view of what can happen. This is a 1 hour chart, by the way. All right. Now, the trend line here, as you can see, the orange trend line, indicating the resistance because it's connecting multiple tops, multiple resistance spots. And when price breaks above it here, that indicates that we could be indeed starting that wave 3 or the wave Y, right? We said that this is either a 1, 2, 3, right, of a lower degree of 1, 2, or this W, X, Y with an ABC here. Now, as you see, just looking at one chart doesn't always give the answer. Sometimes you need to look at multiple charts to estimate what is the most likely. Sometimes looking at one or two charts gives us two certain kind of possibilities, and often enough they're aligned. Not always, though. In this case, they are. Both are bullish. There's always the chance, of course, that the ABC could finish a bigger correction and its downside. Right? In that case, we have invalidation levels like this and this. Those are the levels that would invalidate this bullish count. And when price pushes through that, then we know that that analysis is not valid anymore. This is not a 1-2 if price breaks below the first red line. This is not a WXY if price breaks below the red line. All right, we'll talk about that a bit later as well, but those are, it's very simple. That's the invalidation level, and we know exactly when the analysis is valid and not. All right, unless the invalidation level is broken, the bullish count is the most likely at this point. And the tools indicate when we could expect that. The tools actually translate the analysis into reality, into a practical approach. And you see another candlestick, a pin bar, right at the minus 61.8 target as the price approaches this level. You see that? So that's how you can use that price action. Of course, it takes time to practice it, but if you're already using candles and candlesticks and candlestick patterns and price action, then this will come a bit more naturally. You just have to only fit in the wave count to come up with a plan in a way. All right. Talked about trend lines already in the previous slide. Yes, trend lines are also very useful. Trend lines indicating the potential for traders to invalidate or to find invalidation levels, to find break spots or bounce spots. And basically, they're very useful as a decision spot. What is a decision spot? Is basically you're saying to the market, if you break here, my analysis is correct. Or if you break here, it's incorrect. Or these two lines indicate the bounce and break spot. If price breaks below or above any of these two, that's what I'm looking for. All right, Jenny, the last one was an hourly chart, by the way. This is an hourly, okay? And the one before was a 4 hours. 4 hour, 1 hour, and now we're looking at daily. So trend lines are good to give ourselves kind of a yardstick, give ourselves kind of the freedom in our mind to say, okay, if price is still between this and this trend line, I won't do anything before price proves itself. Often enough, when the price is in a range and price is halfway to range, in live webinars, I say price is in the middle. I'm not interested in trading it. I want to see it either go to the top or the bottom of the range or break out of the range. And that's because I want to see price at kind of confirming what it wants to do. If it's in the middle of something, it can go either way. The probability is not on my side in most cases, and I rather have the patience to let the market decide, and I follow the market instead of trying to predict which way it goes. All right, so I want to let the market kind of make that move, and I follow along, I tag along. Okay, so trend lines on the daily chart. Okay, the purple box is where we're looking at the euro dollar on the 4 hour and hourly chart. Okay, basically this upside here, you see this where I have the green circle, that hourly upside that I talked about. All right, that's just one bullish day on the daily chart. Okay, that upside during the day translated into that one bullish day. Okay, then we see the pullback. All right, here on the hourly, that pullback is basically this wick on the second candle. All right, and then we see a follow through. That's this third bullish candle, or the second bullish candle, the third candle. Then again a pullback, which is the kind of the doji after that, the fourth day, and then again a bullish side, which is this bullish candle. All right. So what does that mean? Well, when we look at the daily, we were talking about the fact whether this is a W, X, Y, or actually like this, sorry, or is it the 1, 2, 3 movement? Well, when you look at the daily chart, you might be considering the fact that it's probably more WXY. All right, with the simple reason is that the market on the daily chart is choppy. So I spoke about the various options on the hourly and the 4 hour, but when you look at the daily, you got to conclude that the WXY is more likely than the 1, 2, 1, 2, 3 scenario, just because of the choppiness, the range is going on the daily chart. So that's why tools like trend lines, because we see a resistance line coming in here, right here, this one, and multiple time frame analysis help, because by looking at 3 charts, I established that the WXY is the most likely. Although there were multiple scenarios when only looking at the hourly, and even including the 4 hour, but with the daily, the third time frame added, we kind of rule out, or we assess the probabilities, and then we came to the conclusion that WXY is the most likely in this case. All right, because we can see that resistance trend line coming in. We see that the market in general is choppy. So price indeed respected that trend line for the third time, moved down, all right, and found what? Another support level. Why? Well, we have a trend line with 3 hits. We have a very strong 108 bottom with a weekly support. So we see a lot of reasons why price, when it comes back to 108, why it's potentially could bounce again, right? A lot of support, and indeed the bounce happens. And if you would go back to the wave analysis that I do daily for Admiral Markets, you would see a headline called "Your Dollar Rechallenging the 108 Level." And in my opinion, there was a decent probability that indeed a bounce could happen. Now, will the rally be 100 or 200 pips, or will it be 300 or 400 pips? Sometimes we don't know, right? We don't have a crystal ball, but the fact that there will be a bounce was, in my opinion, a high probability. Was it a sure fact? No. because everyone actually should work with probabilities, and it was a fair, decent probability. Maybe, I don't know, if I had to choose a number, 70, 80%, I don't know, but decent. Now, and the third point here, we got a break. And a break is maybe, in this case, it's 50-50 really. To me, a bounce here was likely, a bounce here was likely, and the third in the area was 50-50. And why was it more likely, why was a breakout more likely in the third scenario than the first scenario? Just because we bounce off the bottom here. When you can't break a bottom, right, that means maybe in this case we're bouncing off the bigger bottom of the range with a bigger top of the range all the way here. So there was that chance to go and fill that part of the range. Okay, so it's basically just analyzing where the space is at that moment. And we got a break. But anyhow, let's continue. Also, from a wave perspective, this was labeled as a WXY. And yeah, that Y can, typically would go to about 100% of this, which is about the same. They're about equal now. All right, so that would make sense. Okay, anyhow, let's move on. Let's talk about oscillators. Oscillator is a very, very, very useful tool. And the reason why is because it makes the wave count less discretionary. It gives rules to counting waves, and that's very cool and helps a lot. So how can oscillators actually give you sometimes a confirmed count, or close to confirmed, maybe? First of all, I use the awesome oscillator, but I do think that probably the MACD could give something similar. Now, as you can see, this is the euro dollar daily chart. Of course, we were in a big downtrend since last year, May 2014. And what do you notice with the oscillator here? When you have a classical 1, 2, 3, 4, 5, you will notice that wave 3 has the strongest oscillator reading. And that's a very cool thought, because when you have that in your pocket, when you know that the oscillator should be the strongest with wave 3, that removes the guessing about what wave 3 is. Sure, we have rules and guidelines. Sure, we can use fibs. But by looking at the oscillator, we can know whether wave 3 has happened, or whether it has not happened. The wave 3 oscillator, the oscillator during the wave 3 must be the biggest. Either it goes deepest down or the furthest up in an uptrend. In this case, down, right? So what is the wave 3? Where is the wave 3? Well, very simply, we know when looking at this chart that this is the wave 3, right? Now, we're not always sure at that point. Now, why is that the deepest? Why is that wave 3? Because the wave 3 has the most power. The wave 3 is known for its most impulsiveness and has the most momentum. Wave 3 is the strongest, must be the strongest. So that's why the oscillator should be the strongest as well. Because the oscillator shows basically the difference between moving averages. And the price has to drag the moving averages so that the oscillator is strong. Now, this removes a lot of discretion from knowing where the wave 3 is. All right, so from there on, we can actually build and expand our wave knowledge. When we know that wave 3 on the oscillator should be the deepest, we know that this here is the end of wave 3. All right. We therefore also know other things, that this is wave 5. And why is that wave 5? Because the oscillator here is showing divergence with wave 3. The divergence here, the wave 5 oscillator is lower, is lower, right? The wave 5 price is also lower, or actually this is higher, sorry, excuse me, right? Y5 oscillator is higher, price is lower. That is divergence. That is a classical signal of wave 5. So we know that that is wave 5. We also know, therefore, that this is wave 4, the correction in between them. And we also know that wave 1 or 2 is before wave 3. So the origin, of course, is point 0. That's where it started. And we can look back and try to look where wave 1 and 2 is. Wave 2 and 4, typically the oscillator goes back to the 0 line. Yet another oscillator rule. And these are great tips, and boost the wave analytical potential of anyone by a factor of 3, I think, or I don't know. It's a very, very practical tool. So we know that this is therefore most likely wave 2, and this valley here, right, is wave 1. So that is most likely the wave 1, 2, 3, 4, 5. And all this price action in between here from 2 down to 3 with this oscillator reading here, those are internal waves within wave 3. And then we can try to make a guess, or not a guess, but an estimate here, although sometimes zooming in to lower time frames helps, because then you can see this part, right, where I have the blue box, a bit better. But looking at that, judging from this, it looks like a wave 1, 2, 3, 4, 5 within 3. I should use a different color. Red 1, red 2, red 3, red 4, red 5. Now we cannot see it too well here because we need a different time frame. We do see here a bit of a dip. That's why I have wave 2 there. We see that this is the strongest. That's why I have wave 3 here. And we see that this goes to the 0 line. That's why I have wave 4 there. So you can read it a bit. But of course, if you zoom in to a time frame that you see that more properly, you can read it a bit better. All right. So wave 1, 2, 3, 4, 5 should have an oscillator reading that goes like this. A dip, back to the 0 line, strong, back to the 0 line, divergence. You see that the oscillator, in this case here, weak, when it starts showing divergence between these, and then the oscillator indeed mostly below it, only some tad upside here and here. All right. To go, the 0 line basically is, just in case, is the middle line right here. It indicates whether price is below or above. This line right there. You see it? Anything above it is above the 0 line. Anything below it is below the 0 line. When the oscillator is below it and it retraces back to it and starts to fall again, then this is a retracement to the 0 line. This is a retracement to the 0 line. This is a retracement to the 0 line. And here too, most likely. All right. So what can you conclude? The wave 3, the wave 5, the wave 4, because most of the time it should go back to the 0 line. The wave 2 also, the 0 line. Wave 2 and 4 are 0 lines. Wave 3 is the strongest. Wave 5 is divergence, right? And wave 1 is actually less strong than wave 3. And then within wave 3, you can again do the same practice, right? Here too, you see that same motion, right? Strong, stronger, or let me say it this way, strong retracement, strongest retracement, divergence. You see that same kind of pattern. Two and 4, 1, 3, and 5. Now, when you use this, you can have a lot of wave analysts, and they could have different wave counts, and there could be quite big differences between what they have. But when you use the oscillator like this, the number of options certainly becomes a lot tighter. There's certainly a lot easier to find an agreement between you and me when we both use that oscillator. So it, I think, certainly, in my opinion, is a fantastic tool that I cannot stress the value more, because it just helps so much with finding analysis that we can agree upon and that has value for you. Now, is it perfect? Well, almost maybe if you hear me talk now, but no, of course there are situations where it's not clear, but it gives a lot, a good robust approach. All right, let's move on and talk about some other tools. Fractals and moving averages. All right, this is again a very cool tool. Fractals are basically support and resistance levels. Fractals indicate where price, a candle that, well, basically shows the support and resistance. If you have a group of 5 candles like this, then this candle is the fractal candle. Why? Because the candle high is higher than 2 to the left and 2 to the right. Could be more, but it cannot be less. So as you can see, these fractals are these triangles, and they generally indicate what the trend is, because when you have lower lows and lower highs with fractals, it's a downtrend. If you have higher highs, higher lows, it's an uptrend. If they're equal, it's a range. So it's a pretty quick tool to see that. Moving averages, of course, well, that's, I think everyone knows. EMAs I'm using, 21 EMA band, which is a EMA close, high and low. And well, the cool thing about using that and waves is the fact that when the wave 1 starts, the moving averages will probably be still aligned to the opposite direction. In this case, we see a downtrend, right? So the moving averages are obviously still bullishly aligned. All right, so wave 1 often is what we don't know yet. Well, we could have an idea that this is wave 1, but it could be a wave A, 2, because we're not sure perhaps about how far this falls. All right, now, in any case, what you see with the moving averages is that price goes back to the 21 band and goes to the long-term moving average and then starts breaking below it. Drags the moving averages below it. Now the moving averages are bearishly aligned and then starts to pull them even further. That's the process of wave 1 going into a wave 2, going into a wave 3. Now you cannot see that too well, unfortunately. Sorry about that. But basically, add these moving averages to your chart, and you'll see that process better. First of all, price will go back to the moving averages, and then it will start breaking below it and dragging it away. Once you start to get these big gaps between the moving averages, that is also increasing the likelihood of it being a wave 3. The bigger the gap, the more likely the wave 3 is. And as you can see, not only that, but price stays below the 21 band. Another characteristic of a wave 3, or an impulsive wave, in fact. Whether it's a wave 1, 3, 5, A, or C, all these momentum waves typically have price staying below or are contained within the 21 EMA band. A wave 2 and a wave 4 often see price go back to the long-term moving averages. Similar to a wave C as well, 2, 4, and C. All right? So those typically go to the long term. Now, you could have internal waves, because this is a wave 3, right, went very far. Within that wave 3, we can see that price made it a couple of times back to the 21 band, right here, but not always, right? So those will probably be wave 2s and 4s on the lower time frames. All right, so that might be a bit confusing. Let me first start with the fact that long-term moving averages right, are often wave 2 and 4. And the impulse is 1, 3, and 5, stays below the 21 band. Okay, that's clear. Then we have the ABC correction. This is an A, right? It goes back to the 21 band. The B dips below it, but doesn't break this bottom. The C brings it back to where? The long-term moving average, right? Or whatever, WXY, same thing, right? So that's why I said the C also going back to the long-term and the A going back to the 21 band. So you can use the position of price versus the moving averages to also get an idea about what the wave count is. Now the gap I was referring to is between the 21 and the 144. You see that green line, the difference between them? You see that green line becoming bigger here? That gap is becoming bigger between those moving averages. That's a typical characteristic of an impulsive wave because they're being pulled apart. The 21 is being pulled away from the 144 here and 169. So let's take a look at, this was a daily chart what we looked at. Now we're looking at a 4-hour chart. Okay, and within basically what I'm looking at the 4-hour chart from here. Because when you zoom in, you're going to see different things again, of course. And what you see here is the start of that new fall, that new drop. What you see here is price going back to the long-term moving average. And then again, that being a retracement spot, price moving away, price moving back to it, away, back to it, away, like that. Stays below it, all right? Now, as you can see here, this really is one move with 1, 2, 3, 4, 5. Perhaps there's an internal 5 somewhere. I didn't do the count beforehand, but because there's some kind of here, another hook back here. So perhaps this is a 1, 2, 1, 2, 3, 4, 5 to finish 3, to finish 4, to finish 5. In any case, you can see that of a lower degree, the 21 band could be a wave 2 or 4 if the price goes back to it. Of a higher degree are often, or actually this, but anyhow, this could be again a higher degree, but you get the point that the 21 bands are often a wave, internal wave 2 and 4, and the long term is often the bigger wave 4 or 2. Okay. All right. This is a correction, as you can see, a flat correction, typical for wave 4 as well. And this price breaks below these fractals, breaks below these support levels. We get one more acceleration away before then price actually corrects with an A, a B, and then a C that goes where? Right to the long-term moving average, filling this space between them with bullish price action. You see that right there. All right, more examples. 15-minute chart. This week, all right, what do we have? Well, let's start our analysis from this moment. Bearish price action, but then followed by bullish price action, engulfing basically the previous bearish price action. Moving averages are bullishly aligned. 21 is above the 144, price is above the 21, so bullish environment. All right, so when price basically hooks back to the long-term moving average, or in fact the price goes sideways until the long-term kind of hits it in a way, and price uses the long-term to bounce again. Price moves away from the 21, all right, and in this case we're having corrective price action. Why? Well, because price then moves back to the long-term, right? If it would be impulsive, we would stay away from the long-term moving average for a longer period of time. All right. Now, generally, this could be an A or a W or maybe even a 1, right? But you can see that ultimately this equals this. It's about the same length. So it's probably going to be A, B, C here to finish a bigger W. So the X goes back again to the long-term moving average. We get a bounce at the long-term moving average, just like we had the wave B. So you see a bounce of B and X at those long-term moving averages. You see wave A, which is a difficult one to trade, but wave C is easier because we already have everything aligned. All right, then we see a continuation. Now this could be the N, this could be a W, a Y, or perhaps we get a extension. Maybe Y is further. Maybe this is only, again, another A, B, C of a bigger extended Y. All right, so price goes up for A. We have divergence here between these tops like this. So price goes back again for wave B at the long-term moving averages, finds again support for another rally, which is probably wave C. Finishing blue Y, and then price again goes back to the long term. This process could continue. This could be that Y, the blue Y, could finish a red Y, a W, and this could be a red X. And again, perhaps we could be making a rally. Or there could be reason to find a bigger resistance here. And this could be the start of a new downtrend. In that case, at this level, price should break through it and not rebound. So the long-term moving average from that point of view is pretty critical and can be often seen as a bounce or break spot. All right, it's a vulnerable area, and it's a bit of an area where caution is needed. Obviously, if the trend continues, there's a little bit less risk involved, I think, in general, because you're getting a continuation. If you get the reversal, you're going to have price pushing through those moving averages, and what you'll see then is these moving averages, the 21 band will go below the long term. You'll probably still see a wave 2 or a B, and then you'll get the follow through to the downside. That would be a reversal. All right, so waves are better as analysis. All right, but entries are possible. So what kind of entries are interesting? With the trend entries are internal wave ones. It's difficult, depends what time frame you trade. If you trade a high time frame, it could be possible to trade an internal part of wave 1, right? Which is probably a wave 3 of 1. If you're trading the wave 1 of 1, you're actually trading most likely some type of reversal setup. The other option is to trade a deep wave 2. Internal wave 3s, which is a deep wave 2, a breakout of wave 3, or a shallow wave 4, and a shallow wave 4. These are all the potential ways to trade the waves, right? Let's take a look at these. Wave 1 here, the black one, basically, before you realize that the trend is on the opposite side, many times we miss this wave 1. It's possible only if we expect a reversal here or here, right? Somewhere in the middle of that wave 1, we could, or at the beginning, we might expect a turn of events, a turn of a trend, and then we can still catch it or part of it. Now, if we have clues that the trend is reversing, we might expect this bottom not to be broken and to get a deep wave 2. So trading a deep fib like a 61.8 or 78.6 fib of the wave 2 would be a way to trade that, or waiting for a candlestick at that fib would be ways to trade a wave 2, or trading a trendline break on a lower time frame, waiting for a break, a turnaround, a bounce basically for wave 2. All right, that would be one way. Same thing for the wave 3. We can trade the wave 1, a bit easier now because we have already a wave 2 bottom established, right? So we're trading a lower degree of wave 1, a bit easier. Trade wave 2, same thing as the earlier wave 2. And we could try to finally trade the wave 3, which often sees a breakout, a big push, And we could try to trade breakouts because we have a good thrust in wave 3. So breakouts in wave 3 are good. When we expect wave 3, breakout trading is good because price often accelerates further. Trading wave 4 would mean a lot of patience because we often get a big correction, all right, and we often have only a small wave 5. So a bit less appealing, perhaps, right? Wave 3 is often interesting, wave 3, because you have especially the waves 1, 2, and 3 within those wave 3, all right? Now, obviously, if you have a wave 4, it could be still interesting because sometimes you get accelerations like this for even a wave 5. This is an example of a short wave 5. This is an example of a big wave 5. So it's just that wave 4s are sometimes a bit difficult with finding the moment when wave 4 is really finished. They can take long. But if you do catch them, you can get an extended wave 5 sometimes, and look at this. All of a sudden, it goes a lot further. So, trading the wave 4 itself is not interesting, but trading the end of wave 4, because it's just correction and sideways, but trading the end of wave 4 to catch wave 5 can sometimes be interesting. We just have to be on our toes and on our guard if price fails to really push through that, we be cautious of that, because sometimes we get a small push, sometimes a bigger push. Wave 3 is more consistently bigger. So what ways can we catch those trades? Well, basically with the tools that we already talked about: the oscillator, the trend lines, the candlesticks, the moving averages, the fractals, right? But to give you an example, and this was a practical example I was actually looking at. Do you recognize this here? Talked about it in a live trading room, in fact. I said that this is either a bear flag or the start of a wave 1, 2, 1, 2, but then we need an acceleration. Where do we get the acceleration? Right here. There was a small consolidation zone at the top of that bear flag channel, and when price pushed through it, we got that acceleration. Now, for wave 3, that isn't even too much. It was a modest wave 3, to be honest. Right? It could go further. But in any case, a decent amount. That push through that top of the channel and that blue box consolidation is a breakout. And a breakout for wave 3 would be a good trade. Now, the wave 1, 2, 1, 2 within the channel, as you can see, candlestick patterns are good for that too. Candlestick patterns are good for bounces, or also for breaks. Fibs are good for bounces. Wave 2s are great for trading at fibs, like 61.8, 78.6 fibs. Even wave 4s are good for fibs, because price will often stop at 38.2 fib. Waves 3 are good for trend lines, or pushes above moving averages. Wave 1s depends, right? That could be a trend line 2, for instance, here. Like that trend line. We catch the wave 1 of wave 3 there. Catching a wave 3 could be good to zoom into lower time frames to look for smaller breakouts. Right? Let's see. Trading wave 2 could be interesting just because of the ABC. We're still in the downtrend, right? So you can trade an ABC. And here too, putting a fib on the wave A to get the wave B turnaround for wave C could be interesting. So fibs and trend lines and moving averages. Fibs for pullbacks, and trend lines and moving averages for breakouts, basically. So, from that point of view, for instance, here's a trend line, resistance. I should draw red. Here's a resistance trend line. Not drawn that properly, but could indicate the fact that we can accelerate. So, when cautiously, at certain times, even a breakout in wave 5 is okay, right? Just have to be a bit more cautious than wave 3. That's all. here, for instance, let's take a look at this. We can see divergence between, this is the pound dot, or the last time frame, sorry, is 1 hour chart. Here's pound odd 1 hour chart, and we have divergence between these bottoms, indicating the potential for price to get back to the long-term moving average. Because remember, when there's divergence in play, we're probably see a 3-wave correction back to the long-term moving average, or a trend reversal where then the moving averages switch to the other side. Okay, so with divergence, we might have the expectation of price getting there. Now, we see in the black box there, price making a bullish move after showing divergence. That could be a wave 1 or A. All right, let's forget the, we could do further analysis, look at multiple time frames to find out which of those two are more likely. But for this example, it's not relevant. So what can we do? Well, we can put a fib on from the bottom to the top and try to look for maybe a 50 fib or 61.8 fib, 78.6 fib, and look for potential long there. Sorry about that. I'm back. The connection was lost for a second. So I was talking about the fact that this is either a 1 or A. We don't know. Depends on multiple time frames. For this example, irrelevant. We can fib from top to bottom, or bottom to top, look for a pullback here, and take a reversal trade, right? Obviously, price is in that downtrend still, so it's a reversal trade. Taking a long at the blue circle is a reversal trade. So looking for perhaps some price action, candlestick pattern, confirmations that price was returning again could be good. In this example, price did turn, and you have to, of course, treat that with caution. You have to test it, that you don't, start trading this idea on wrong spots, and you might get into trouble. So test it on demos before taking reversals like this. With the blue circle, indeed, providing the turn, and that turned out to be the 2 or the B indeed, right? 2 or B. And the green arrow indicating the fact that price extended for wave 3 or C. Now I'll make it red here. Oh, no, sorry about that. Right here, that is, I'll make it blue, 3 or C. Right? Now, what happened after that? Price didn't really get to the long-term moving average, right? Before it made a consolidation. When it goes sideways like this, that could be a wave 4, for instance. Or perhaps the ABC made a WX. Why? As you can see, the exact wave count is not always very important, as long as you have an idea about the direction, right? And price stopping at the 21 band, and you see this trend line, the break of that trend line indicating the follow through for more upside. And wave 4 here, or this price action did not go into this price action, which means that a wave 1, 2, 3, 4, 5 is possible, perhaps, right? Not invalidated in any case. And price stays above the 21, all right? And eventually, here we're getting a bit of divergence. Here this could be read as a 1, 2, 1, 2, 3, 4, 5 as well. Why? Because this part starts to really accelerate, starts to really push. So when we have a momentum like that, we could consider that a wave 3, and then we can recalculate that this is probably 1, 2, and we have another 1, 2 here, and we can recalculate that this is probably not a WXY, what may seem likely at that point, but when price makes that kind of break, we can cancel that thought and say, okay, that was the most likely, but now more upside is likely. So we incorporate the new information, we use that new info. We see that wave 3 had a big breakout, a big momentum push with a lot of acceleration. So we can then conclude that WXY was a bullish pattern, but the bullish pattern is even stronger than we expect, and it's actually looking more like a 1, 2, 3. What does that mean? That means we could expect more. Why? Because now this is the most likely. And we see consolidation, so we can see indeed the break for 5, which only finishes 3. And then again, a pullback where? Of wave 4 for another wave 5. And what do we see then? A retracement to the 21 and then to the long term. Perhaps as a B, C. Not so clear this time, but in any case, price did go back to the long term and short term. So this is how you can make, ideas about when looking at momentum. First of all, divergence, then momentum, then the correction here, then the big momentum here, and you can make judgments all, using the oscillator, using momentum correction, and using the moving averages about what is the current move, what could be the next move, has it changed, has the wave count perhaps look different, etc. You can also trade against the trend, of course. It's more advanced, a bit more difficult, and trade the ABC. You can trade triangles. Those don't break the bottom and tops. Those are good for bounces. Or correction, very corrective types like WXY. It's possible to trade those, but be careful because they're corrective and they are more difficult. They're a bit more wacky. Now, if that WXY occurs on a high time frame, like the euro dollar, is very corrective. But it's happening on a daily chart, which means that on lower time frames, there's sometimes still good movement. So if it's on a high enough time frame, then often it's still okay to trade. But if it's on a 50-minute chart or an hourly chart, it's quite yucky. Here's a dollar yen example. Here you can see not so interesting to trade, but an A, B, C, D, E is still interesting, right? Or maybe the D is here, but anyhow, it's interesting because there's potential bounce spots, and there's a potential E spot where the trade can continue. Especially the E is very popular with Elliott Wave traders because the E has a clear D level invalidation level. All right, and typically a small risk because D corrects deep normally, and a big reward potential because the trend is continuing. So E is very popular. A, B, C, D could be used potentially for bounces. All right, but E with the trend continuation. So yeah, ABCs are possible to trade, especially if we have divergence. There's confluence. We need to find strong confluence of a potential bigger correction. All right, so those are possible. WXYs are possible in a higher time frame. ABCDEs are okay, especially the E. So those are reversals that are okay. Now let's talk about exits. The stop loss should be below or above the origin. So if you're trading wave 1, all right, then basically it has to be below it has to be beyond the starting spot, either below the bottom or above the top. The target could be wave 5 of 1. Or we can even aim for a further target. But we have to live through a deep wave 2. So often the best target is the wave 5 of 1. So we don't have to live through the deep wave 2. If you do want to hang on through the deep wave 2, that's great, and then you have a chance of getting more. Wave 2, well, if you're trading the ABC of wave 2, you would target the wave C. If you're trading wave AB, you would aim for C. And the target of C is the fib target. the minus 272 target, the minus 61.8 target. And you place the fib on wave 8. You put the stop loss most of the time just above or above the top or below the bottom. Wave 3, you can put the stop loss below the wave 2 of a lower time frame. And you can target the wave 5 of wave 3, the wave 3 of wave 3, or the wave 5 itself. Depends on if you want to live through wave 4, because those could take long. So you need a bit of patience for that. If you're trading the wave 5, you want to put the stop loss away from wave 4. Wave 4 typically would not go past 50 fib. Or in any case, we know that the wave 4 should not go into territory of wave 1. Technically, the best stop loss, therefore, is beyond the top of wave 1 or the bottom of wave 1. That sometimes is huge, the stop loss. So practically speaking, it could be better to wait for some price action at a 38.2 fib of wave 4. Place the stop loss below that, or below the 50 fib. Target to wave 5, well, conservative target would be minus 272 target. Or a wave 1, what is the length of wave 1? I'm targeting the wave 5 for that. Now I know that the stop loss and targets went a bit fast here, but just write me otherwise an email if you have any follow-up questions. Does anyone have a follow-up question right now? Chris _ Swarsik, my name. All right. At then hotmail.com. Hotmail.com. Any questions that might take a bit of time, you can write there. Or if you have any questions now, let me know. I got one question, automated software. Yeah, I think that Motive Wave has that. That's a charting software. And otherwise, if it's other ones I don't know by heart. I think that it could be good as a starting spot. I don't know. I never used it myself. The MA setups that I use, good question. 144 plus 169 EMA close is long term. And then I use short term, I use 21 EMA. Close, high, low. Unfortunately, let's see. No, one more question here. Let's see. Does Elliott Wave formation occurs on every price action? Yeah, Elliott Wave is a formation that, according to wave analysts, that it occurs everywhere, every time frame, every chart, every pair, every financial product, basically. Now, practically speaking, of course, if you look at a very small time frame, then it might be very unpractical to analyze. All right, that's the thing. But yeah, and in highly leveraged markets sometimes do see some cases where waves tend to align less with the guidelines than typical because of the high leverage, like Forex. So it is kind of like a common rule amongst wave analysts or theorists that a market with less leverage is a bit easier to use wave analysis. The higher the time frame, also the easier. Now, this is basically a very fast session, I think, and therefore, I would say maybe if this is indeed a lot, or there are a lot of tools and things that were added, could be good to watch it a second time. And if you have any questions, of course, by all means, you can follow up with me through that email I already mentioned. Otherwise, let me show you. This has to be, the voting has changed. We have new webinars, of course, next week. Nennet is back as well. I think Monday, I'm not sure if he has a webinar Monday, but I think so. In any case, Tuesday, Wednesdays, and Thursdays again, of course, as always. And well, that wraps up our two-part wave webinar. I hope you found it interesting. I hope that you got some good nuggets of information there. And wish you all happy hunting and good trading, and still some good August days. And see y'all soon. Cheers.